Welcome to the Deep Dive, your shortcut to getting genuinely well-informed. We sort through the complexities, pull out the core ideas, and aim for those real aha moments. Today, we're taking a proper deep dive into a really key piece of financial law, the Corporation for Public Deposits Act of 1984. Our mission for you. Well, whether you're just curious about how public finance works, or maybe you're a law student grappling with interpreting statutes, our goal is to really unpack this act. We want to make its purpose, its key rules, the legal world it fits into, its practical effects, and, its real-world importance totally clear.
And we're going straight to the source material for this. We're using the official text of the Act itself, looking at its updates, the historical notes too. It gives us a direct view, you see. We'll be distilling the absolute core of it. We'll use plain language wherever we can, obviously, but sometimes you just need the specific legal terms to get the precise meaning across.
Yeah, exactly. And it's important to know right from the start, this act didn't just, pop up out of nowhere. It was very deliberately designed to replace something that already existed, the National Finance Corporation of South Africa. So what we're exploring today is really a story of legislative evolution, of rebuilding financial structures. Okay, so let's start at the very beginning. To really get a handle on this act, what problem was it actually trying to solve back in 1984? What was its basic purpose?
Well, the Act's preamble lays it out quite nicely, actually. It has three main aims. First, the establishment of this new body, the Corporation for Public Deposits. Second, it deals with the investment of certain monies, specific funds received by the government and other state bodies. And third, and this is really key, the dissolution of that older National Finance Corporation. It sort of wraps all these connected issues into one single law.
So it's creating the new and managing the exit of the old. This new entity handles big public funds. How is it actually defined in law, and why is that definition so important?
All right, Section 2 gets straight to it. The Corporation for Public Deposits is set up as a juristic person. Now, that's a fundamental legal idea. Basically, it means it has its own legal identity in the eyes of the law, completely separate from the people running it. Think of it like a company.
Right.
This lets it do things like enter contracts, own property, sue or be sued, all in its own name. It provides a huge amount of clarity and stability for financial dealings. It's like a private company structure, but with a public mission.
Right, a separate legal entity. Now, the name Corporation for Public Deposits gives a clue, but you mentioned certain monies. Section 1 defines public deposit very specifically, doesn't it? It's not just any old government cash.
No, absolutely not. The Act is very precise here. A public deposit is explicitly not general government revenue, the tax money and general income defined under the Exchequer and Audit Act. Instead, it's money that's received or held by the government, including departments like Posts and Telecoms back then, provincial administrations, or by specific bodies set up by law, like councils or funds, that are either required or permitted to invest with this corporation.
Okay, so specific entities and specific types of money.
Exactly. And crucially, these funds must be money that's not needed for immediate use or just for day-to-day operational cash flow, their working balance, and they absolutely must not be invested or used in any other way except under this act.
So quite restrictive.
Yes, but there's a little flexibility built in. Section 4 actually allows the Minister of Finance, if the corporation agrees, to let other bodies, maybe non-public ones, like a specific trust fund, invest their money with the corporation as if it were a public deposit.
Ah, interesting.
So while the main job is handling public funds, there's a door open for others seeking that secure investment channel.
Okay, so we're talking about very specific government or public body money, not needed right away, and channeled specifically for secure investment through this corporation. Once it accepts these deposits, what does the corporation actually do with them? What are its main tasks and powers?
Well, its core duty, right there in Section 3.1, is non-negotiable. It must accept all these public deposits, it must repay them when demanded, and it must pay interest on them. That's fundamental.
Okay, the basics covered.
Beyond that, it has pretty broad investment powers. It can invest these deposits and any other money it holds in a range of secure instruments. We're talking government stock, bonds, treasury bills, also things like debentures or notes from big state-linked entities, the Industrial Development Corporation, the Land Bank, ESCOM back then.
Right, familiar names.
And it goes further. It can invest in other debentures, bills, notes, securities, even bankers' acceptances issued inside or outside the country. Plus, it can simply place deposits with other financial institutions. It gives them scope to diversify, but it keeps the focus very much on secure, often public sector-related investments.
That's quite a spectrum. But yeah, it seems focused on safety and presumably liquidity. What else can it do, operationally speaking?
Section 3.1 covers a lot. It can buy, sell, trade in, or even underwrite these investments. It can pay dividends. We'll get to who gets those shortly. It can have bank accounts, hire and train staff, buy property it needs. But here's a really critical power. It's specifically allowed to discount treasury bills or sell securities to the South African Reserve Bank, or even borrow directly from the Reserve Bank.
Ah, the Reserve Bank connection.
Exactly. That last part is crucial. It's like a financial safety net, ensuring the corporation can always meet its obligations, always repay those public deposits, no matter what the markets do.
Okay, let's zero in on that relationship. The Reserve Bank's backing sounds absolutely vital. How does the Act formalize this? It seems like a bedrock guarantee.
It really is. Section 3.2 is crystal clear. It says the South African Reserve Bank shall not may, but shall make money available to the corporation if needed for repayments. It does this by discounting treasury bills the corporation holds, or buying securities from it, or just lending money against those securities.
So it's a legal obligation on the Reserve Bank.
Precisely. It makes the Reserve Bank a statutory lender of last resort specifically for this corporation, guaranteeing its liquidity. It's absolutely vital for maintaining confidence in how these public funds are handled.
Okay, we've covered what it does, how it invests, that crucial Reserve Bank link. But who's actually in charge? Who controls this corporation, and how is it held accountable?
The Act sets up a clear governance structure in Section 5 with a board of directors. It's a small board, just 4 people, all appointed by the Minister of Finance, and the composition is specific. 2 have to be senior people from the South African Reserve Bank, the governor, a deputy governor, or other top officers. The other 2 must be senior officials from the Department of Finance.
So a balance between the bank and the Treasury.
Exactly. And the minister picks one of the Reserve Bank people to be the chairman. And Section 9 adds another layer to that balance. For a meeting to even happen, the quorum requires at least 1 director from the Reserve Bank side and 1 from the Finance Department side must be present.
Ensuring both perspectives are always there.
Right. It stops one group dominating. Decisions are by majority vote, and the chairman gets an extra casting vote if there's a tie.
Seems like a solid structure for joint oversight. Now, how is it funded? And what about profits? Is it meant to make money like a regular company?
Its financial setup really underlines its public service role. Section 10 sets the initial share capital at 2 million rand, split into R1 shares. This can be increased by the board, but only with the minister's approval. But here's the kicker. Only the South African Reserve Bank can hold shares in the corporation.
Just the Reserve Bank. Nobody else.
Nobody else. And Section 11 makes it clear the bank's liability is limited just to any unpaid amount on those shares.
Okay. And profits.
Section 15 deals with that. After the corporation pays a dividend to its only shareholder, the Reserve Bank, any net profit first goes into building up a reserve fund. Whatever's left after that, and after covering any past losses, gets paid directly into the state revenue fund each year.
So profits ultimately go back to the state.
Exactly. It operates on sound financial lines, sure, but its ultimate aim isn't commercial profit. Its success benefits the public purse directly.
That really clarifies its public purpose.
What about transparency and its legal position compared to, say, normal banks? How does the Act ensure accountability and carve out its special status?
Well, accountability is built in strongly. Section 16 demands proper accounts and annual financial statements. These have to be audited by an independent registered accountant standard practice, but important. Then, critically, Section 17 says an annual report detailing its activities, along with those audited financials, goes to the minister and the bank. And then this is key for public oversight. That report and the statements must be laid before Parliament.
So Parliament gets to scrutinize it. Yes, ensuring that public accountability. Now, about its legal status, this is fascinating. Section 19 explicitly states that the main banking law, the Banks Act of 1965 back then, does not apply to this corporation.
So it's not regulated like a normal bank.
Correct. It's exempt. This means it operates under its own specific rules set out in this act, tailored for its unique public finance job. It's not taking deposits from the general public or making commercial loans in the same way. Its focus is managing these specific public deposits securely.
That makes sense. It has a very different role.
And to help it fulfill that role efficiently, Section 13 also gives it exemptions from things like income tax and certain stamp duties. It really reinforces its special governmental function.
So definitely not a bank, but a specialized public financial institution with its own rule book. Now, you mentioned earlier this act wasn't just about starting something new, but also shutting down the old National Finance Corporation, the NFC. Can you walk us through that side of it, the practical transition?
Yeah, this really shows how comprehensive the act was. It wasn't just, here's the new body, it was also, here's exactly how we wind down the old one smoothly. Section 21 lays out this whole dissolution process for the NFC. It provides for winding it up, transferring its assets, its debts, its rights, its obligations. A liquidator gets appointed to manage all this, selling off negotiable assets and securities.
Sounds complex.
It is. And interestingly, things that couldn't easily be sold, like maybe certain specific obligations or non-negotiable assets, were transferred directly to the new corporation for public deposits. And again, the South African Reserve Bank played a final, vital role here. It was legally required to step in and buy any NFC assets the liquidator couldn't sell, and to advance funds so the liquidator could pay off all the NFC's depositors and liabilities and compensate its shareholders.
Wow, so the Reserve Bank guaranteed the wind-down process, too.
Absolutely. It ensured stability throughout the transition. It shows this wasn't just a name change. It was a carefully managed institutional overhaul designed to centralize oversight and bring in these explicit safeguards.
Why is understanding that history, that transition, important for us listening today?
Because it highlights the act's real-world impact. It wasn't just theory, it was a practical plan for a major change in how public funds were managed in South Africa. It shows how they moved from the older NFC system, which dated back to 1949, to this new, consolidated structure, ensuring continuity and stability along the way. And the schedule at the end of the act really underlines this. It lists all the other laws, big ones like the Insurance Act, Pension Funds Act, even the Banks Act itself, that had to be amended or partially repealed to make space for this new corporation and integrate it properly into the whole financial legal system.
It really shows how interconnected all this legislation is.
Definitely. It's like adjusting one major piece of machinery requires fine-tuning many others around it.
So we've really dug into the Corporation for Public Deposits Act of 1984. We've looked at its clear purpose, managing specific public funds securely, its investment powers, that unique, crucial link to the Reserve Bank, and the strong governance and oversight mechanisms.
Yeah, a deep dive like this really brings home just how much precision goes into public finance law. It's a real blueprint for how governments create dedicated bodies to manage public money safely and efficiently. It acts as a key pillar for financial stability.
It really is a fascinating look at institutional design and how laws evolve to meet changing needs. This technical act tells a bigger story. And maybe to leave you, our listener, with something to think about. This act was born in 1984, last updated significantly in 1998. Think about how much the financial world and technology has changed since then. Digital currencies, new complex investment tools, different public-private partnership models. How might a foundational act like this need to adapt or evolve to stay effective in today's world, to keep ensuring public money is managed soundly well into the future? Something to ponder.